Hi, I'm Ken Heyman. As Managing Director of the Advisor Institute at AllianceBernstein, I meet with financial advisors every day. One thing I hear expressed over and over is their frustration with how much they are juggling. The advisors I talk to are constantly trying to balance competing priorities, from managing client relationships to prospecting for new business, and of course, the tasks of leading their team. This problem of juggling is why we created the AllianceBernstein Digital Coach. This is a proprietary tool that draws on the wisdom of behavioral economics and unique perspectives from the Advisor Institute's practice management experts. In less than 10 minutes with the Digital Coach, you will be able to identify and prioritize the top needs of your practice. And armed with those insights, you will be well on your way to tackling the challenge of limited resources while positioning your business to seize opportunities for growth. Let the Digital Coach guide your journey to success. Visit abfunds.com/go/digital coach. That's abfunds.com/go/digital coach. Hello and welcome back to Secrets of Successful Advisors with Ken Heyman. I'm Ken Heyman, and we're changing things up a little bit today. Instead of the normal dialogue we have about behavioral economics and its application to the work of the retail financial advisor, we're going to have a different conversation because the events of the day are going to create some challenges and some opportunities in advisors' life as we think about the geopolitics of the moment and some of the things that are going on surrounding the conflict with Iran. So what I've done today is I've invited our chief strategist at AllianceBernstein, Rick Brink, to join me. We're going to have a conversation that's all about how to have the hard conversation with clients when they call up and they're upset, and how to bring them down from that distress and make a creative opportunity out of that conversation. So Rick, thanks so much for taking the time out. This is obviously a crazy busy time for you, but thanks for stopping by and having this conversation with me today.
Thanks, Ken. I'm excited. Many would say this is a long overdue team up. I'm glad we're getting this going. The band's together.
There you go. Well, we do a lot of work behind the scenes at AllianceBernstein. You've been at the firm actually longer than I have, and I've been here 21 years. Rick's role at the firm is our chief strategist, and we think about the role of the strategist as maintaining an understanding and awareness of what it takes to invest wisely and to operate according to those deep principles of investing that really keep us on the rails and moving through whatever the events of the day are. Rick has some very interesting ideas. A lot of them translate into practice. But as a way of framing our conversation today, let me just remind you about this idea of the application of behavioral economics to the work of the retail advisor. That is the purview of the Advisor Institute. We don't talk about markets because that's not our area of expertise. We actually don't talk about products. That's somebody else's job at our firm. We do talk about how advisors can work more effectively with clients. And there are times when the events of the day and the experiences that clients are having really require us to move much more into the tactical events of investing and help clients think differently, carefully, and more thoughtfully. In order to do that, we really have to remember the basic structure of how clients process information. We borrow this, of course, from Daniel Kahneman in the world of behavioral economics, this idea of system 1 and system 2 thinking. System 2 being that logical, deliberate, thoughtful, careful, analytic processing. All of those skills, those cognitive skills, really are required for investing effectively and successfully. Of course, System 1, the more powerful system, as Kahneman describes it, is this fast thinking system where the brain uses heuristics and shortcuts and operates according to a whole set of biases. The most fundamental bias is a bias to impulsive action. When clients become distressed, their desire is to take action. In fact, the only thing that feels right to the client is this need to take an action to remedy the problem. And of course, all of us professionals in financial services are aware that that's likely to be the worst possible time to take an action. when you're feeling a strong emotional reactivity, a bias to impulsive action. So for years, we've taught a very simple model. And what I want to do today is I want to borrow from Rick's expertise, a lifetime of expertise in advising people on how to invest successfully, and plug that into our 4-step model that we've published in our program titled Managing the Hard Conversation. Now, what we mean by hard conversation here is a conversation with a client who has been emotionally stimulated by the events of the day. It could be stimulated intensively by the media, perhaps their social media feed where they're getting raw information, maybe the traditional media feed where the news is distressing them. They're reading something or watching something on TV. Could be a conversation with a friend who renders an opinion. There's just dozens of ways that clients can be activated emotionally. But what we know about that is when they get activated emotionally, that brain is shifting from that solid cognitive, logical, deliberative system 2 down into system 1, and they're going to be reactive. And that's precisely the time when an advisor needs to be able to intervene, which isn't to say in any way, shape, or form, this is not a time to take action. I think Rick has some opinions about good actions to take in this context. But what we want to avoid is the client taking impulsive actions, extreme actions that are ill-advised in this situation. And that is where we want to equip the advisor to work. So before I have Rick weigh in, what I want to remind you of is the basic framework of our 4-step conversation that we publish in our white paper, Managing the Hard Conversation. That's available from the Advisor Institute, AllianceBernstein. Any one of our wholesalers can give you a copy of that. And this is a good time to perhaps sit down and refresh your skills in this area, because it is likely, as this conflict continues to drag on, that you're going to have more and more conversations with folks who kind of cross threshold into that distressed emotional state. In step 1 of the strategy, we imagine you've received a phone call, perhaps you're sitting with a client in a review, and you realize the client's very upset. Counterintuitively, what we say to every advisor at that point is, don't start talking at this point. Say to the client a simple question. Tell me about how you're feeling. You sound pretty worked up about this. Stretch out on that a little bit. Tell me what you're thinking. Tell me what you're feeling. And then our advice is for you to be quiet. Now, the reason for this is that if the client is in an emotionally activated state, the part of the brain they're operating with is down here in the limbic system, the brain stem. And this is a part of the brain that operates primarily on emotions. Its the job is to put the human being into motion, to take action, to protect themselves. Well, the problem with that is that part of the brain doesn't use language and it doesn't have logic. It's pure emotion. But the moment you ask the client to talk, they have to use this cognitive tool, their neocortex, where language is the material of thought. And so by asking them to stretch out and talk to you, you're actually moving the energy of the brain and, in fact, the activity of the brain from the limbic system up into the neocortex. Now, that doesn't happen instantaneously, so our advice is sustain the conversation. So they ask them to start talking about things. Demonstrate you're curious. Pay attention. Don't just start thinking about what you're going to say next. There'll be time for that in a minute. But what you want to do at that point is you want to invite them to continue talking. So the best strategy we have for that is simply to say to them, say more about that, tell me more, and to maintain your authentic curiosity about how they're feeling. Ask them to talk about where the ideas are coming from, who they've been talking to, what they're listening on the television. Don't criticize it, don't critique it, don't change it, just let them talk. Now, the second step is like unto the first, but it's a little more advanced, in which you ask them, well, tell me, what do you think is going to happen? What kind of thoughts are running through your mind about the future? And what you'll find is they will be taking whatever is going on in the moment and they'll be expanding on it, what in psychologist language we call catastrophizing. And so, again, your instinct is going to be to try to correct or inform them. This is not the time yet. Let them keep talking. What do you think is going to happen? Get them to stretch out on that. Say more about that. Say more about that. The best tool you ever will use is this idea of say more, stretch out, authentically curious. Maybe you're now 5, 7, 8 minutes into the conversation. Then you can say, well, how will that happen? What do you think will cause that? Now you're asking them to go way up into analytic thought. To ask the question how means they have to think about cause-effect relationships. The strategy is literally to do that, to get them to think in cause-effect terms, because that forces them to use the neocortex. Now we're going to pivot. And we're going to bring it to the point where you get to talk. And this is where I'm bringing Rick in to offer us some opinions about this and how to use this opportunity to really fill the space with really meaningful and useful information. The third step is to say to them, well, let me ask you this question. Now, we've been talking for about 10 minutes, and I hear where you're coming from. Is that what you think is going to happen, or is this more just about how you're feeling right now? And get them to make a distinction between thinking and feeling. 99.9% of the time, they're going to say something like, you know what, this is how I'm feeling. I don't even know what to think. In fact, that will be the most common thing you'll hear. And that's a wonderful opportunity for you to pivot them now that they're up in their thinking patterns. They're using language. They're able now to process information. And so you can say to them this, and this is the key where I want Rick now to show you how he would do this if he was talking to a client and the client was saying, I don't know what to think about this. And what Rick would say is this. He'd say, well, I totally understand how you're feeling. A lot of people are feeling that way in this time. I talk to a lot of clients. A lot of them are feeling that way. It's perfectly normal. But we have found that in this situation, there are actually some things that if we understand them, give us a perspective where we can take some action. Now, that pivot in the fourth step allows you now to step into that role of behavioral coach. You're able to say to them, well, you know what? My job is to understand what's going on in the world, to know what to do about it. And this is an opportunity for us to talk about it. Now, Rick's going to give you a whole bunch of perspective on this. None of it's necessarily for you prescriptive. It's our best thinking about how you might have this conversation. But what it does is it allows you to express your convictions. If your conviction is the situation and our portfolio are well positioned, then you simply can reassure the client that we're taking the appropriate actions by pointing to those places where things are appropriately positioned. If, however, this is an opportunity perhaps to pivot in some part of the portfolio, what a wonderful opportunity for you to show the client not only you're thinking clearly about it, you know what to do about it, but you're responding to their desire to take action. So we've just said to the client, is that what you think, or is that just how it feels right now? Well, we have a way of thinking about this that you might find helpful. Let me take a couple of minutes and stretch out on it. Rick, would you take the ball from there and walk us into some of your thoughts about what's happening right now and how you might address a client who calls in with some distress?
Yeah, of course. Thanks, Ken. And I echo, even my conversations, there's so much of an element about how people feel and how they should approach it in the moment. And what's really interesting is that most of the time, the market has a couple of general rules. The first is the market typically doesn't care about something until it decides to care about it, and not 1 second earlier. That's a classic. And the poster child for that is geopolitics. It's almost like I feel like within our offices, there's something like a fire extinguisher looking case, but it says in case of geopolitical emergency, break glass. And you tap it open, and inside there's a list, and there's 3 items on it. It's like the 3 commandments or beliefs around geopolitical risk. The first is whatever it is you're worried about, it's not going to happen. And typically that is the case. This too shall pass, or it doesn't even happen in the first place. The second is if something does happen, it's almost certainly going to be short-lived. And then the third is if it does have legs, if it does last for a while, it is going to become localized. And a case in point for that is Russia-Ukraine. Look, there were 100,000 Russian troops amassing on the Ukraine border, and the S&P 500 was hitting new highs. The market didn't even really begin to react to it until the attack happened in the following February. And even then, the next month, the S&P was up 4%. And so this is probably the first operative thing, is that right now, the market is trading oil. It's not trying to find a new price for it. There's behavior everywhere in what we're seeing in trading right now. It's why day to day with every announcement, things can go up or down. We can find hope. We can move away from hope and everything else. And geopolitics, for that reason, has always been difficult once something happens. And I almost have a kind of Tourette's whenever there's an energy thing that immediately I say Strait of Hormuz. It's always been the discussion. But the thing is that I don't want to step away from the topic, but for me, Iran isn't the cake. It's the icing. It's the overlay. It's not the base. And it's not even the whole icing. It's one of several ingredients just in the first quarter of this year. So we had the incredible, unfortunate development of, in one of the podcasts that I am a part of talking about 5 buzzwords in the first 2 months of the year were moving markets. And we recorded it. And the very next day, Iran became the 6th. But just if I zoom out to the first quarter, what everyone was thinking about was one, remember the labor revisions. 2025's numbers were taken way, way down, historically down. And so now we're questioning the strength of labor, therefore consumption and GDP. Tariffs were struck down by the Supreme Court. Another version is getting implemented as we go. But again, same question. What does that mean? That people have to be paid back? Another fear, another concern, another opportunity. The safety trade shows up. We've forgotten it already. It seems like years ago. Gold, silver. Over in the other camp, Bitcoin's doing something different. What's the story with the dollar and the treasury in the new world? That had its own audience. And then the fourth buzzword was Warsh's nomination to be the next head of the Fed, which in turn dinged the safety trade. One headline dings things like silver because people say, okay, we like that guy. Things are okay. So suddenly a lot of the safety trades change. And then finally, because of course it must, AI showed up in the first quarter again, this time with hardware and software. And then there was a paper from a little known group in the latter part of February that threw everybody all, crazy again around the idea of AI and labor, right? So if we really want to think about what we should be thinking about just in the first quarter, there's a good half dozen. And Iran just becomes the sixth buzzword. But even there, we're still dealing with the cake. So look, for me, I usually frame the world starting right before COVID started, right? I want to take everybody back to a kinder, gentler time when COVID hadn't taken place and inflation had been running below 2 for a decade. GDP was settling in somewhere around its trend of 2. The Fed funds rate was incredibly low. And then COVID hit, and we got something that is incredible. It's historic. I'm a bit of a financial historian, economic historian. It's my thing. And this is off the charts. I call it, because I'm a Marvel movie fan, the League of Supervillains of Inflation. If you prefer, the era of exogenous inflation shocks. But the bottom line is, if you lined up history's greatest inflation impulses, you would find war, you would find pandemics, you would find global tariffs, you would find superheating and cooling rates. In fact, as we did this work, we went back and said, of the League of Supervillains, what's the average distance in time to go back to those 5 supervillains? And it was 82 years. But in the last 5 years, they've shown up back to back to back to back to back. Now with Iran, we get another inflationary impulse. Now, why is that such an important conversation? Because one, inflation relates to rates relate to everything, but they certainly relate to the bond side of the equation. So the first thing that I would say that I anchor on is that for the last 6 years, the world has been asking itself, when do we get back to a world before COVID? When do we make our way back where this makes its way out of the system? And now we have rates back down to where they were, inflation back to some semblance of somewhat like that, and GDP, same thing. And we've been waiting on Godot with each of these kind of shocks. With Iran, we have been introduced to yet another kind of investment opportunity that is overlooked. So I should confess that most of my career is in fixed income and in bonds. I'm a global bond guy, and so my predilection is to make my way toward rates. But the first thing that I would talk about is manage duration now. What we've seen is rates have gone up again. They've gone up largely on the back of inflation expectations climbing. What does it mean to us as investors? Is that expected increase in inflation temporary, or does it really have legs? Because my list tells me that this is going to be short-lived and localized. And if that's true, then the first investment opportunity is to take advantage of the level of rates right now. All of that expected inflation is, to me, is inflation-adjusted yields in the future. I think that for many investors, bonds have become a side conversation. But because of COVID, because of the supervillains, and because rates got to such a high level, the level of real yields have become very enticing. And I don't believe that they stay around for a long time. And so the first really anchored conversation I always have is, how are we managing duration? How are we handling such a large part of our portfolio? The second is, Iran laid bare again this idea of energy. This has come around a long time over time. But what's interesting is we've been talking about energy for quite a while here, but it hasn't been about the supply of energy. Our concerns and our investment opportunity has been around the demand for energy. Think data centers, right? So no data center, no AI, no energy, no data center. So the next thing that I'll bring up is there's an opportunity to understand that and to engage in the idea that energy creation is becoming a fundamental element around the world. Look at Germany, look at Japan in Sakaguchi's election, look at Mexico. There is this call to arms almost around what is systemically important to defend. Yeah. That's structural. That's not going anywhere. And let's pretend that it ends with AI, but it all begins with energy and how we produce it. So the second thing here is to step back and see where we can take advantage of that paradigm shift, in my opinion. And what's interesting is a lot of that lives in a forgotten index, it seems like, although it's being remembered now with flows, and that's value. Ever since the GFC, value went to the back burner. There have been no active inflow years for active value funds since GFC until the last year. In fact, there had only been 2 years of positive inflows from passive value, and only because it had its own version of in case of emergency break glass, such as tax increases and inflation go to value, or tax cuts and inflation go to value. Those are the only 2 years where you saw the flows. Why is it so important? Because so many of those components live inside of value. By the way, as you go back into there, you're also going to find some of those other building blocks of AI live inside of value. So I like to find areas where there's inefficiencies. So let's look at the forgotten index that's quietly and not yet entrenched becoming remembered. And then the third is, and this is really a big thing for me, I'm obsessed with the sequence of returns. For a long time, from 1980 to 2000, a period that I obsessed about, returns were so high that we started to anchor on the idea that we could actually generate 18% S&P returns per year for years and years, which is what we did for 2 decades. Stunner of stunners, if you didn't know that. 11% on treasuries for almost 2 decades. But as returns started to come down, one of the things that I've talked about is retirement is such a critical element of what we do, and funding retirement, improving the probability of it, that the idea that if the level of returns aren't going to be high enough, the second thing that I would say is we can get a lot out of the sequence of returns. And so the third point that I would bring up is there's a lot of emphasis on the Mag 7 and the related, and for good reason, but I would turn everyone's attention toward the S&P 493 and the idea of being intentional here. This is not just, well, should I own it? Should I not own it? It's how should I own it? And toward what end, right? If I had a t-shirt, my t-shirt would say participate and defend. And I've always believed that there are ways to build portfolios that I can be involved in gains in markets. I can get most of a market's moves, but I can embed downside protection, because that, as it turns out, is the killer of retirement plans. And so how can we participate and defend here? Inside of the 493, you'll find some of my favorite betas. Quality, which again gets thrown around, and that's because there's so many ways to define quality. But if I'm trying to be intentional in this space, and I am looking at rates, and I am taking advantage of inflation expectations that I think are going to fade, and I am looking at the forgotten index because I understand that energy is such a big part of the world, and the supply chain of AI is, and I see it living inside of there, and I want to play structurally to that end. I also believe that these factors that we toss around, if we're more intentional around them, like U.S. large cap quality, like low volatility, like dividend growth, that are areas where we can embed downside protection to marry to the other trades. If I am concerned as an investor, I have right to be. There's always something lurking around the corner, and we can't fix it post-mortem. So the idea is, what can we embed? And what do we believe about where we are now versus where we are tomorrow? And I believe in the coming tomorrow, wherever that is, that the league of supervillains fades and rates are going to make their way naturally down. We will have either captured those rates or we won't. Number two, the world will cotton on to the idea of that we're getting back to the idea of manufacturing and making things, and we need the things that allow us to manufacture and make things, which is going to lead us back into the forgotten index and value. Somewhere Buffett is saying, how could anybody forget that? So it's from the French. And then lastly, the S&P 493. Let's be targeted here. Let's become students of those components, and let's make them strong ingredients, because that's how we get to the recipe that leads back to my t-shirt, which is participate and defend. And Ken, that's what I have.
And that is a wonderful summary of an enormous amount of complexity. But as we're listening along, we start to realize, wait a second, all these forces can be understood. And obviously, what Rick took maybe 20 minutes to do a conversation that he could probably teach for a week of 1-hour sessions around each of these dynamics. But what he's done is he's demonstrated that these are things are not only understandable, but he understands them. And what that leads to is the ability to do something about it, to do something proactive, to take an action. Now, I don't think any of our place here at AllianceBernstein to tell you that we know exactly what action you should take. We absolutely do have a point of view. And one of the things Rick does in his day job when he's not on my podcast is he spends an enormous amount of time with our wholesaling staff, equipping them to have this kind of quality conversation. So if you're interested in exploring how to operationalize this just a little bit more, here's what I would suggest. We have a white paper called Managing the Hard Conversation. It gives you those 4 steps. I have another white paper titled How to Present Your Capital Markets Perspective. It's not a capital markets perspective, but it is a structure that you can use to do what Rick just did. And to a great extent, Rick did exactly what I teach in that, obviously because that comes out of the larger thought leadership pool at AllianceBernstein. But fundamentally, what I would recommend is the organic and dynamic conversation that you can have with one of our wholesalers that leads to various strategies and solutions that are available. That would equip you not only to understand how we might partner with you, but how other partners might partner with you so that you can have this incredibly reassuring, anxiety-reducing conversation with your client. Rick, I want to thank you so much for taking the time to come by here. I want you to come back when we have another opportunity to stretch out on this. And I want to say to everyone that's listening, thanks for taking the time to visit us here on Secrets of Successful Advisors with Ken Heyman. We'll be back whenever there's an opportunity for us to lend you our insights from the behavioral sciences. But for today, I would say thank you very much for listening and join us again for our next podcast.